You've seen Stickman teach money moves before, but today's different. This episode dives straight into what's actually shaking the market right now: silver's collapse, tech's tumble, political shockwaves, and global tension. Stick around to the end, because by then you'll know exactly how to survive the storm and protect your crown. Markets are loud and angry right now. Prices swing like a chandelier in a storm. Headlines pile up faster than Stickman can polish his crown. Today, we'll walk through the exact shocks hitting portfolios, why they matter, and how to survive them step by step. The silver crash. Silver exploded higher through 2025 and into January, driven by a mix of physical demand and speculative positioning. That left silver with an outsized weight in commodity indexes, and index rebalancing forced the sale of billions in futures contracts. Citi estimated the flows at roughly $6.8 billion in the early January rebalancing window. On top of that, exchanges raised margin requirements and clearinghouses tightened risk, which forced leveraged accounts to liquidate positions. Reports also document big bank activity on COMEX delivery notices and physical flows. Institutional players, including large custodial banks, were active in delivery and position adjustments during the squeeze and unwind. The combination of index rebalancing, margin hikes, and large institutional position shifts created a liquidity vacuum. When selling hit, there were fewer buyers, so the decline rapidly snowballed. This wasn't just a metal moving on its own, it pulled risk through the plumbing. Forced selling on COMEX spilled into ETF and derivatives markets, triggered margin calls, and tightened liquidity in related commodity and currency markets. When traders were forced to sell, other asset classes felt the shock. Commodity currencies, miners, and even some equities with high commodity exposure saw outsized moves. That's why a silver-centric event can suddenly feel like a wider market crisis rather than an isolated commodity story. The Nasdaq crash, big tech names led equities weakness in recent weeks. Earnings that missed expectations, cautious guidance on AI spending cycles, and rotation out of high multiple growth into value all pressured megacap names. Think of the usual suspects: large cap AI and cloud leaders, plus consumer internet names that repriced after growth worries. Because the Nasdaq is concentrated in those megacaps, their declines pulled the index sharply lower. ETFs and passive funds tracking these indexes magnified flows as investors rebalanced. Liquidity thinning in the small and mid-cap tech names made moves steeper, and headlines around earnings or regulatory scrutiny amplified intraday volatility. When megacaps wobble, they don't wobble alone. Passive funds that own a slice of the index must sell or face tracking error. Active funds may sell winners to raise cash. Liquidity bleeds across names. That's why concentrated exposure to a few high multiple tech stocks can create sharper drawdowns than a broadly diversified portfolio. The Epstein files release. The DOJ released a large tranche of documents tied to Jeffrey Epstein, thousands of pages, photos, and records made public after new transparency legislation and rolling releases. The files mention many high-profile individuals and corporate contacts. Media and political scrutiny flared immediately. Top Justice Department officials have publicly downplayed the near-term prospect of criminal charges for newly named individuals, but reputational scrutiny alone has financial consequences for some corporate leaders and boards. Reputational risk can be a market mover when it ties to a company's leadership or board. If a named executive is central to strategy, investors may mark down a company's valuation while uncertainty persists. Stock volatility spikes around news cycles, proxy fights, or governance questions. Even if no legal action follows, litigation risk, resignations, and distraction from corporate priorities can hit earnings, and investor confidence. Press attention becomes a real financial risk factor. Geopolitical hotspots. In the Middle East, U.S.-Iran tensions have fluctuated in recent weeks, with diplomacy and military signaling both in play. Oil and Gulf markets moved on signs of escalation or de-escalation as talks and regional posture shifted. Russia's long war in Ukraine remains a structural driver of European energy risk and pricing. Pipeline flows and political choices keep an energy premium baked into markets. Additionally, developments around Venezuela and U.S. moves there have reopened conversations about oil flows and longer-term geopolitical risk. These conflicts affect shipping, insurance costs, supply lines, and energy prices almost immediately. Geopolitical shocks raise commodity prices, energy, metals, push investors into safe havens, gold, U.S. treasuries, and can trigger currency swings in affected regions. Energy-sensitive sectors and multinational supply chains see both margin pressure and demand uncertainty. Defensive sectors and cash often benefit in the short term while growth assets get punished. Trump policy and Fed. President Trump's nomination of Kevin Warsh for Fed chair changed market expectations about monetary policy posture and the dollar. Markets interpreted Warsh's reputation as relatively hawkish on inflation and central bank independence, which strengthened the dollar and raised the cost of dollar-priced commodities. That dollar repricing contributed to the downward pressure on metals and crypto. Separately, tariff talk and trade policy rhetoric increase cross-border uncertainty for exporters and supply chains, another direct channel into earnings and sentiment. Fed signals matter because interest rates change discount rates on future cash flows. A stronger dollar and higher real rates typically depress commodity prices and increase the hurdle rate for high-growth equities. Tariffs and protectionist moves directly raise input costs for companies and can reduce margins or shift expected future earnings. A re-rating of multiples often follows. How to actually survive this volatility. Verify the mechanics before you panic. Find the credible flow story, index rebalances, margin hikes, Fed signals not the loudest tweet, trim position concentration. If your portfolio leans heavily into megacap tech or commodity-linked stocks, rebalance toward diversified ETFs to blunt single-name shock. Mind leverage and margin. Forced selling is a liquidity amplifier. Avoid using borrowed money in already volatile markets. Distinguish reputational noise from legal risk. For the Epstein files, check corporate disclosures and counsel statements. Reputational headlines can move prices, but legal outcomes take time. Have dry powder and a plan. Dollar cost average into high-quality names or ETFs during dislocations. Use predetermined buy levels rather than emotion. Hedge strategically if appropriate. Short-dated hedges or cash buffers can protect near-term capital without sacrificing long-term growth. So how to overcome? Volatility is the market's price tag for opportunity. Preserve capital, learn the specific drivers, and act when the panic yields bargains for quality companies and diversified funds. Focus on cash flows, not headlines. Maintain a plan and let time do the heavy lifting. Key takeaways. Silver's crash was structural. Index rebalancing, margin hikes, and big institutional flows created the sell-off. Tech/Nasdaq moves were driven by a re-rating of growth names and rotation into defensives. Epstein files create reputational, not immediate legal market risk. Watch disclosures, not rumor. Specific conflicts, US-Iran, Russia-Ukraine, Venezuela, tighten energy and shipping risks, raising premiums across commodity markets. Fed-related policy shifts and the Warsh nomination pushed the dollar and repriced risk assets, feeding through to commodities and growth equities. When markets roar and silver, tech, politics, and wars all try to steal your crown, be the steady monarch. Study the flows, protect your realm, and plant seeds for the calm after the storm. Hit like, subscribe, and keep learning how to turn your Stickman moves into millionaire grooves. Because at Monarch Stick, every move counts towards your money crown.